Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time, joined by Pierre, our senior manager and mentor. All right. I understand, Pierre, that you have 33 years under your belt and possibly 33 more to come.
In theory.
In possibility. And you've also said not much has changed over 33 years. Mistakes that happen. Yeah. Have they changed a lot?
How people make them have, but it's still the same mistakes that people have made.
Okay, so how they make the mistake is different.
Yeah.
Instead of writing off cars, they're writing off drones.
Yep.
Right. But
phones versus pads of paper, stuff like that.
Okay.
Computers versus.
So what it is, the physical thing is different. It has changed over time, but the act is still the same.
Yeah.
Okay. Hit me. What do you got?
So there are 5 that people do, and it's not glaring like you think. Like, oh, you drive your car into work every day, and that's a mistake.
I mean, we like to bring up writing off boats.
Yeah. Well,
despite your business being in a desert.
You can have a boat in the desert if you're trying to prepare for a flood, I guess. Moses could have written that off because that was his business, saving animals. But when you talk about the 5 that I'm talking about, we're talking about missing legitimate deductions, poor record keeping, and not making estimated tax payments, choosing the wrong business structure, and no year-round tax planning. Those are where you make your biggest mistakes. So that's what I mean. That has not changed in the 33 years I've done this. It's just how they're doing it is changing.
And I want to pause too, because sometimes businesses have adapted to these mistakes. Yes. So for example, the last one you brought up is no tax planning. And for example, like Kaizen here, the business structure is tax planning throughout the year, not just, hey, we'll do your taxes, see you next year to do this. It's coaching and helping them throughout the year to avoid this very specific pain point.
Yeah.
Okay. But obviously it's still an issue.
Yeah. So let's start with that one.
Sure.
When you don't do tax planning during the year, you struggle at the end, and you can make mistakes, and that can cost you money. You can also pay a penalty, which clearly costs you money. And if you had planned during the year and made plans to either buy more equipment or expand your business or pay your estimated tax payments.
About to say withhold more tax.
You could save all that money, and you're basically ignoring it and taking it as a cost of business. I didn't plan. That's the cost of business.
Oops.
Yeah. Now there is a legitimate call. I have a client who never pays his estimates, and he'll pay like $500 or $800 in penalties. But I know those estimates that he didn't pay, he used to make more money instead of making those estimates. I always say, why don't you make the money and do this? But he takes that money and he spends it on these. He doesn't go into debt for the new tractor. He pays cash for it. And he looks at that expense of that $800 as, well, I got this new tractor and I don't have to pay the interest rate for the next 5 years. And in his mind, that is okay. But most people, it's just a penalty. It's a cost of doing business. It doesn't have to be. And that's why you're losing it. If you would just plan ahead, do some planning, have the knowledge in your background of what you're doing, you can save those dollars. And they can be sizable.
Okay. Now let's get to some more obvious ones, and like your deductions.
Yes. So missing legitimate deductions. A lot of people are very good at squeezing every deduction they can into the business, but a lot of people forget that you took that trip to go see another shop that operated on it. Yeah, you were there for 5 days, but that day you went to go see that other shop. Say you went to Disney World, right? You took your family. The trip cost you a lot of money, but part of your trip, part of maybe your rental fee for that day and your lunch that day, you went over to see another auto dealership and how they're knocking it out of the park because you met them at one of the conferences. That part of your business trip is a deduction that you're just leaving on the floor.
Yeah. And you brought up, we may have seen him at a conference. That whole conference could have been it.
Well, definitely the whole conference. Yeah.
So one thing I'll say, because I do this too, is I will go through my calendar and I'll say, what did I do this year? And I'll go through each, not like every single day, but like, okay, these are the things that happened throughout the year. Hey, I went to this conference, and then just take the 2 seconds and say, is that related to my business? Okay.
Yeah.
Simple as that. And then, for example, all the purchases I made, I'll go back to all the places that I buy equipment for and say, okay, some of these things were for me, but some of these are for my business. I'll print out all the receipts, get it all together, send it off.
Yeah.
So that's what's great about technology. You can go back and get receipts real easy as opposed to back in the day. But again, take the time to do it because it adds up.
Yep. And every deduction that you don't take is taxable income. Think of it that way. Mm-hmm. But now don't go hogs get slaughtered, pigs get fat. Go get the deductions that are legitimate. Don't take that whole Disney vacation as a deduction on your business. But people do it all the time.
And if you do have questions, that's literally why you have an accountant, right? So that you can have that, hey, where do I draw the line?
Yeah.
They are your moral compass, I'd say.
So the standard for the IRS is ordinary and necessary. Mm-hmm. So as you say, do I need a boat in the desert? Is that ordinary and necessary to have a boat in the desert? Probably not. But you might have it if how about
this? You're making canals in the desert.
Yes.
When the water starts flowing, you'll probably need a boat.
Yeah. It doesn't sound like the best business model, but it could be necessary. So I had a construction company that bought a boat and I questioned him on it. I was like, you can't put your boat on the book. He's like, well, it's not like some luxury. It was a little John boat. And I was like, what do you use it for? He's like, well, we build culverts at parking lots. And sometimes they fill up with water. And I need this little boat to go out there to either aerate it or change the pipes or something. And it wasn't. I saw the boat. It's a little tiny motor. I mean, you could borrow it on the weekend and go fishing, but it was there to do stuff in the water. And I didn't make that connection first off the bat, but he had a legit ordinary necessary business. It was not a, $500,000 Bertram sport fisherman. It was a boat used for that. But on the books, it just says boat. Yep. So you question it. So that's one of the biggest things. Remember, every deduction you're not taking is taxable income. You think of it that way, you're going to start. That's when people get a little too greedy and take everything. So don't take it all. But
and that falls also into the poor record keeping, right? As opposed to writing boat, as opposed to
John boat for a little culvert repair or whatever. Those basins that fill up near parking lots. So yeah, poor record keeping. And talk about the changes that have been made. Mileage. You can go back and go take your calendar and go to the places that you went and do all your mileage in one fell swoop. Yeah, through Google Maps or whatever. But they also have software that'll track it for you. Like if you're traveling all the time, you have that software app, it loads it up every time. We have expense reimbursement software now that we didn't have then. You had to write it all down. You still need to keep the receipts, but you can scan them in and not worry about leaving that receipt at the hotel or leaving it in your suit and letting it go through the dry cleaner.
Yeah, stuff it's like a little app that you just take a picture and it's done.
So if you don't take that picture and write it down and you left it in the hotel or the rental car, you're going to remember that on March 15th or April 15th next year? Probably not. And you're going to miss it. That's taxable income. That's costing you money.
That's right.
So good record keeping, especially with technology today, is a no-brainer to get every deduction you can.
And if you think about it like, okay, hey, this was $200. That is therefore taxable income as opposed to I just spent $200 and I can get some form of reimbursement. It's not $200, but it's something.
Yeah. That's a great point. And that $200, if you do that every other week for a year, that's a big number, right? So
it adds up.
People make mistakes, but give yourself the best ability to not make the mistake. That's what good record keeping is. The other biggest thing, I know we've talked about in other episodes, not making your estimated tax payments. I used it earlier today with the guy who doesn't make his estimated tax payments. If you don't make those estimated tax payments, April 15 comes around, not only could it cost you the $800 for that guy, but say you're the person that doesn't have the $10,000 to make the payment now because you didn't plan for it. And what did we use before? Your water heater went out and you spent that $10,000 on that. If you had given it the money, you would have. Now, not only are you late because you didn't make the estimates, now you're late from making the final payment. So they'll give you like late filing penalties, late payment penalties, extra interest, all cost you money. If you had good record keeping, took care of everything, proper planning, and made the estimates, you wouldn't be creating this taxable income, right? So I'm sorry, this is not taxable income. This is an expense that you don't get to deduct. That's the worst of both worlds. Costs you money, and you didn't get to deduct it.
So you're shooting yourself in the foot twice.
And you're probably shortening your life too by waiting till April 15th to make your payments. Like you're giving your stress.
You're giving yourself stress. That's it's unnecessary.
That's free doctor advice from your accountant.
And the last one
is business.
Choose the wrong business.
Yeah. So there are different reasons to have different business structures. Some things we've talked about in past episodes is the classic example, if you own a building in an S Corp and you need to sell that building. Say you have 2 buildings in S Corp, you need to sell that building. If you are in an LLC, which we like real property to be in, real property being buildings, land, and that, if you sell it in an LLC, you can transfer it out or move it to a separate entity easier than if you move it out of the S Corp. It's a taxable event. And little things like that can cost you thousands of dollars. And that's just property entity structure. We've talked about payroll. You can pay payroll tax on an active business for the portion where you're actively participating. If you're an LLC, you have to pay payroll tax on the whole amount of the income at the end of the year. And that can be some sizable difference. We use a classic example of $100,000 of income versus $50,000 of wages. That payroll tax payment is $7,500 in tax savings by making that switch. And if you never make that switch, that's $7,500 every year that you are losing money on just because of your structure. There are plenty of other examples, but that's a pretty concrete one.
Again, it's not the end of the world. It's, hey, you're just paying more in taxes. Are you okay with that?
And there are other reasons to not do that, right? I think about everybody asks me all the time, should I get another vehicle? Okay, tell me more, right? Because if you buy a new truck every year, you'll get the deduction, but the only person making the money is the car dealership that you keep buying trucks from, because they'll depreciate. When you go to trade it in, you'll get less value. But if you what did I say? The
$100,000 truck?
No, well, yeah, I did use a $100,000 truck before, but if you, I forget where I was going with this.
Only the auto shop is, or the
only the dealership is making the money. Yeah, so you don't want to keep doing that. Your buddy might buy a truck this year and it saved him all kinds of money, but you're not getting ahead by doing that. So you have to make decisions based on each year what's going wrong, whether it's going to cost you money, because that really is costing you money by buying a new truck every year.
And the shop, by the way, that auto shop will love you.
Yes,
they will be excited.
Yes,
that you will have people waiting for you every time you come in.
Sum up: keep capture all those deductions, keep clean records, pay your taxes on time. Those are all things. It's like showing up on time costs you nothing. All of these things really only cost you something if you don't do them.
Yeah, I guess realistically, it's more just maintenance stuff in the end. It's nothing that you have to do that's extravagant. It's just stay on top.
Yeah, exactly. It's not, oh my God, this is $1 trillion. No, but if you're giving away $7,500 every year, why not pay $2,500 to an accountant and save that just for that advice right there?
Yeah. Perfect. Anything else you want to add, Pierre?
I'm good.
All right. Thank you.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.